This is Trepp Wire Week in Review for week ending February 19th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, the number of COVID hospitalizations and deaths are down approximately 50% from January highs, and the administration pledged that 90% of Americans could get the vaccine by summer. A slew of economic data was released signaling that the economy is heating up. Retail sales jumped well above expectations, driven by online shopping. Producer prices had the biggest gain since 2009, and multifamily housing starts surged last month. And it hasn't gone unnoticed that the 10-year Treasury hit the highest level in a year. Meanwhile, a deep freeze in Texas has pushed oil prices to the highest in over a year. Manus, the headlines are fanning the flames of concerns over inflation.
They certainly are. And, with the pieces of economic data that you just mentioned, in many cases, the differential between the actual print and the estimates was wide. Like, we were beating these things by huge margins. Retail sales, as you said, I think that the number was up 5.7%. People were expecting 1%. PPI was up by a factor of 4 over what people were expecting on the headline number. When you back out food and energy, I think it was up by a factor of 6. So what you saw this week is people coming to grips. And let's not leave out some of these other things. Bitcoin, right? It surged from 30,000 to 40,000, 50,000, before you could say Bob's your uncle, right? It's oil prices, right? Which is eventually going to make its way to the gas pump. But all at once, these signals are flaring. And I guess it was Tuesday, traders came back and immediately, bid the yield on the 10-year Treasury up, right? It jumped 10 basis points in one day. It had been at about 80 basis points right around election day, maybe less, maybe like 75. And now we're at 130. And I think people are asking themselves, is this 130 because everybody's rattled, or is this 130 as a speed bump on the way to 150 or 175? And we do know that rising interest rates are not the friend of real estate valuations, whether it's residential or commercial. So something to really keep an eye on. I think that part of this is driven by people trying to get ahead of what they think will be a very robust recovery. And part of it is the realization that there's a very good chance we get this 1.9 trillion. And, we're not just opening up a fire hose, we're opening up 100 fire hoses, right? And I think that this is, start to hit the it's hit the radar of money managers and investors and others.
You mentioned it a little bit, Manus. What I found funny was that the last unemployment report that came out, I think Powell came out and said, well, the true unemployment rate is really more like 10%, because he looked at those who were not looking for work, and he looked at all the things that they never in the past have ever quoted. Like, they've always only looked at the headline number, even when, there's only 60% labor participation or something like that. But they don't do the same thing with inflation, at least so far, right? So they're still looking at the CPPI, which somehow is not increasing very much, even when people are creating virtual playing cards and spending thousands of dollars on them, right? Like, there is so much cash awash in the market, in the world, that we are creating more and more digital, I don't want to call them fake, but we're creating more and more fake things that people are putting their money towards. If that's not a sign of inflation, house prices, right? Commercial real estate prices staying where they are or growing, even though underlying fundamentals are not that strong. Like, I think if you were to be completely honest with yourself and include asset prices in inflation, like, there's some serious inflation going on.
Well,
right?
When you get right down to it, it's not the stimulus per se, and it's not the checks that they've been writing per se. It's not those things alone. It's the bluntness of the instrument, right? We have people that are still working, that are taking home their salaries as accountants or paralegals or other white collar jobs. They're probably flusher than they have ever been because they're not paying to commute. In some cases, they move back home. They're not paying rent, right? They're not paying a train ticket. They're not paying for gas. They're not going to restaurants and bars. And on top of that, we've sent them, so far 2 $600 checks with perhaps another $1,400 coming. And what this means is that when we come out of this, I've heard a couple of analogies. I've heard somebody say it's going to be New Year's Eve every single night this summer. And I've heard, it's going to be the roaring 20s times 20. All of these things are true. And there's a panel we're going to talk about a little bit later where this was brought up by a big New York City developer who said, there's really no nuance to the relief, whether it's eviction moratorium or, check writing. So there's an enormous amount of money sloshing around. And I think at some point, these inflationary trends show up even more.
Looking at office news, occupancy levels are still below 30% in many of the populated cities. So we're seeing more companies shedding their office footprint.
Well, it's a very interesting topic. What I kind of figured out this week is that this is the point of the biggest debate right now. What becomes of office over the next 3 or 4 years? I think that people on the retail side, know it's a disaster and they know where the disasters are likely to be, at their worst. I think on the hotel side, even though it has been a disaster, I think people are clinging to the side of the cliff with their fingernails and they believe that this will come back. Multifamily, I think everybody is of the belief, or there's a consensus that this kind of muddles through in most places, except perhaps maybe some 24-hour cities. And the high-end luxury and industrial, we know that that's just, a lights out great performer right now. But when you talk about office, it is a really 50-50 proposition. I sat in or I participated on several panels this week, and they really underscored this theme. We ourselves at Trepp, we hosted a community call. It was arranged by our Aaron Timko. We had Professor Dave Hartzell of UNC, of the Keenan Flagler Business School, Professor Tim Ridio of University of Wisconsin, and Ores Manzi of CRE Direct. And, they couldn't be more on opposite poles, right? Dave thought, we have recency bias, but big cities come back, right? The office is where people are going to want to be, to collaborate, to be seen, to work their way up the promotion charts. And Tim was the other way. Tim was of the belief that the productivity gains have been so big from work from home that CFOs and CEOs will not be able to ignore these. So that was kind of a piece. And I can give you 2 or 3 other conversations that were similar. So, if there was a CMBX that was really office centric, that was like CMBX 6 for retail, I think that you would find this equally divided between bulls and bears. We saw more inventory hit the front page, to stick on the theme of 2 sides of the coin, right? The positive and the negative. We talked about the market in these terms last week as well. On the negative side, Seattle, a couple of big sublease parcels coming out this week. F5, which owns their own 520,000 square foot building, or I should say occupies a full 520,000 square foot building, putting about 125,000 square feet out for sublease on top of the 75 they've already sublet. So almost half the space in that property, they're looking to, move along. That's on top of Nordstrom and Amazon, which have already announced big parcels of space that they're going to either give back or never take. And then Dropbox in that city as well, 90,000 square feet. So in the past, we've talked about New York, San Francisco, Chicago as being real areas of concern. Now Seattle starting to show up kind of in that, trouble list.
So I just want to say that I was talking with a few people this week, and one was a few of them were in Iowa, and they were in the office. and they've been in the office since June. And they said, our whole plan in the state was flatten the curve, and as long as hospitalization stayed manageable, like that was okay. And we've had case counts, but we haven't had a spike in hospitalizations. We haven't overwhelmed the hospitals. So we've been here and we've been operating. And in a lot of ways, I've gotten a lot of positives out of quarantine and working from home from a personal perspective. But I'll tell you, I think we totally underestimate the mental health aspect of this and the psychological aspect of this. Like humans were not meant to be on Zoom for 12 hours a day. At least this human was not meant to be on Zoom for 12 hours a day. So, more power to the Iowans who've been back in the office and operating nicely. We also talked with someone in Phoenix who, like, basically anecdotally again said, every license plate I see is from Illinois and California at this point. And, our friends in Texas, although they're struggling now, thanks to this crazy snow that's happening, they've been seeing the same thing for even before COVID, but especially now. And they've had their economies open. I mean, people want to be around other people. And I think that that's always going to be true. I don't think that it's a binary proposition for office, but I do think that, there's a good 30 or 40% gray area, right, of companies that still want to have an office, but can very easily drop tons of square footage because they don't need 5 days a week.
Well, the way you started that last set of comments, you said the people in Iowa have been in their office since June. And my first reaction mentally was, that sounds like my first 2 years at Trepp, that I stayed in the office from June until February and never left. And that's what it felt like. With
I said to him, I said, "Is this heaven?" And he said, "No, it's Iowa."
Oh, there we go. Right from the
Nice.
field of dreams. I love that. A couple of other office things that, good and bad. Another one that's not great. The major cities are not the only places where people are looking to slough off space. Dun & Bradstreet in Central Valley, PA, is looking to get rid of a third of its space in its single tenant property. That particular property backs a $28 million loan. It's part of CMBX 10, and they're looking to get rid of about 60,000 square feet. So it's a phenomenon that seems to be kind of gaining momentum. Kent Swig this week at a conference in New York that we'll talk about a little bit later, he said that in New York right now, 29% of offices are being sublet right now, which is just an extraordinary number. And it's really hard to picture how that gets squeezed out of the system at a time when people are thinking, let's go, 2 days in, 2 days out, that type of thing. On the more positive side, in terms of lease renewals, happy to report that the Bank of America building in San Francisco at 555 California Street, it got lease renewals from B of A and Goldman Sachs. B of A is going to consolidate all its San Francisco space into 250,000 square feet in that office. And I forget what Goldman Sachs's renewal was for. I think it's 100,000 square feet. That particular building, incidentally, is 70% Vornado and the 30% the Trump Organization. So if people were concerned in some way that tenants were not going to want to be affiliated with, Trump-owned buildings or something like that, at least in this particular case, that wasn't a consideration at all. B of A and Goldman Sachs,
until they heard you remind them right now.
Well, I hope I don't trigger a run on B of A and Goldman Sachs. That was certainly not my intention. I have a lot of really long-standing friends at both organizations.
Did you mention the conversion of the Sam's to a T-Mobile customer center?
And it's kind of a mixed message, positive, right?
It is. I mean, anytime you find retail being used for anything, and I mean anything, right, that's a good thing. So the fact that we're taking an old Sam's parcel and, turning it into a T-Mobile customer support center is great. It's 130,000 square feet in Richmond, Virginia, at the White Oak Village. So, again, more evidence of retail conversions actually happening rather than being a thing that's being considered.
And then, of course, in the opposite direction, we see a Courtyard by Marriott being converted into a flex office.
Yes, I keep coming back to these remarks by Kent Swig and Steve Witkoff. They both were of the belief that New York City hotels are in for a really, really long haul. This was part of a conference that was hosted by the Commercial Observer. Max Gross did a great job of moderating that. As I said, Steve Witkoff and Kent Swig were the people. Let me give all the credit where it's due. Burned-in Accountants and Advisors. They were the sponsor of the event. But a lot of their comment was New York as an entity is struggling. The words that came out of the panelists was inhospitable, right? That in the past, under different leadership, what you had was cooperation, that the people around the table, the real estate group, the local politicians, or I should say the borough presidents, the mayor, some of the labor unions would sit down together and say, how do we make this work? Because there was an understanding that if you're trying to squeeze the real estate developer, sometimes the guy that really gets hurt is the person cleaning rooms, the bellhop, the people checking other people in. And, what their point was that, a lot of that's been lost, that it's lose-lose when you make things so inhospitable that people go to places like Miami Beach and other cities to conduct business. In this particular case that Martha was referring to, there's a Midtown West hotel that's being converted into a flex office, which I hate to say it, sounds a little bit like going from the kitchen to the frying pan?
The frying pan into the other frying pan.
Come on, Martha, what is it? Help.
Fire, frying pan to the fire.
There we go.
Yeah, so that was a Courtyard by Marriott. I mean, we also had, jumping into hotel stuff real quick, just a couple of earnings announcements, earnings calls, earnings reports. So Marriott, which is basically the largest hotel franchise in the US, unsurprisingly, we saw pretty significant drops in RevPAR, in revenue, in earnings per share, and so on. RevPAR was down 64% from a year earlier. Fourth quarter occupancy was 34.9% across the portfolio, which actually strikes me as not that bad, but it's down from 70% in the fourth quarter of last year. So, I mean, it's
I'll take the other side of that coin. I thought that was shockingly disappointing. I knew we had hit 15 or 20% occupancy when COVID was first starting. We saw some recovery, but by and large, I was of the belief that these numbers were going to come in 42, 45, maybe even as high as 50, right? In big parts of the country, and Marriott is everywhere. I thought they're going to have enough places open that they're going to show substantial improvement, and they'll be one of the leaders in this space. I think that 34.9% was scary as all get out, down 35% from fourth quarter last year. And you got to think at this point, first quarter of 2021, it's got to be worse, right?
Yeah. So then we had Hilton also posted a big loss of $224 million. RevPAR was down 59% year over year in the fourth quarter. Hyatt also had a $200 million loss, RevPAR down 69%. So not overly surprising, but just some numbers there for if you're trying to figure out your underwriting.
Well, I'll take it back to hotel for one more minute. I took part in a conference today, Thursday, hosted by JMBM. It's the law firm Jeffer, Mangels, Butler, and Mitchell. Had about 1,000 people on. It was about distressed hotels and where they're coming out. Some good names in there: Argentic, Greystar, Citus, HREC, which provides runway capital, Manhattan Hospitality. So it was all supposed to be about hotels, but we did deviate into other property types. On the hotel side, there seemed to be a lot of unanimity around the thesis that explosive rebound in vacation destinations, lagging rebound in office and conference center cities, things like that. But interestingly, even though it wasn't on the agenda, many of the special services brought up office, and they joined Tim from Wisconsin in saying that this is a bigger problem than people realize. We're going to see big challenges refinancing big loans as they come due, especially those where the rent roll is uncertain. We are going to see contraction of space. We're going to see lower renewal prices. And this will lead to an uptick over the next, and it wasn't long term, really 12 to 24 months that we'll see this behavior.
So if you are of the mind that there's going to be explosive rebound in a portion of the hotel space, we've actually seen a really nice start to the year in terms of issuance of CRE CLOs. And, you know, I wouldn't be surprised if the likes of the Argentics and the Annalese and the TPGs and KK, like all those types of guys are starting to think about, like, there's a serious opportunity here. If I can go give a guy a bridge for a year and get him through, like, he's got a loan maturing this year and his RevPAR is down 60% and his occupancy is down 35%. I can go bridge him for a year with a bunch of reserves and then, you know, make some serious money, right?
That was the HREC angle. They're the ones that provide runway capital. They were talking about the merits of preferred equity as being that entity that comes in, provides operating capital to get through the crisis, cures the loan, provides some working capital. And they, I don't want to give away the entire thing. The JMBM guys did a really nice job, and I believe it was recorded. You could probably go out and find it. But he did give indications of, you know, what the price is to play in that market, you know, for those that are actively seeking preferred equity, you know, what the going rate is for that.
It's kind of the private market Hope Act.
That's right.
Right, except much more expensive, I'm sure.
Right. The Barstool Dave of
maybe we should start the Trepp Wire Hotel Fund.
There we go.
Right. We could have a hotel owner on every week for 2 minutes, give us their spiel, and we'll raise money from the listeners.
From your mouth to God's ears.
So you mentioned government and business working together in one of the many webinars that we participated in, or at least watched. And we saw this week that the federal ban on foreclosures for government-backed loans was extended to June 30th. But it is important to note that the federal moratorium on evictions for renters is still March 31st, barring any state laws, which of course confuses the whole thing.
Yeah, so I was trying to kind of decipher this myself, and I believe that the moratorium on foreclosures doesn't include multifamily, although I may not be right about that. I would assume it's single family, Fannie and Freddie and other agency-backed loans, although I know that there was a 90-day moratorium on multifamily evictions back when this first started. So I'm not sure if, I don't think that this includes that. The eviction thing, honestly, it would surprise me if they didn't extend that too, right? They just probably haven't gotten around to it at this point.
At the Commercial Observer panel, you know, one of the big topics was this moratorium, and a point being made by, I think it was Kent Swig, was that there is no income threshold, right? There's no means test for this moratorium to apply, right? So you could have a job, you could have been employed this whole time, and your job can be very well paying, but you can choose just to stay in your apartment, you know, as long as you want, right? And not pay rent. And the point being made by the panelists was, you know, what this leads to is an inefficient allocation of capital, that to the extent that this continues, and to the extent that people don't know how long it's going to go on for, what we're going to look like on the other side of this. Is this going to be a perpetual type of thing where everybody gets 6 months for free, that you will see less building and you will see less housing? And I tend to agree with that. I think that all of these stimuli or protections that we have done in the last 10 months or so, they've been blunt instruments. They've been for everybody: checks, moratorium, protections, and they really should have been means tested. And there's this little thing nagging in the back of my head, which kind of terrifies me a little bit when I think about it. What were to happen to this country if the prevailing attitude becomes, only suckers pay rent, or only suckers save for college, or pay off their student loans, or go to work, or pay their mortgages? There's certain honor and pride in, the guy who works 30 years and saves for his kids' education and toes the line and pays his taxes. If we become a society where only suckers do that, it's kind of terrifying.
Manus, you're not a sucker, all right? But if you just bought a couple of Bitcoin a few years ago, you wouldn't have to do any of this stuff.
Then
all right? Maybe you are a sucker.
Then I'd be a player.
I think I'm the old soul millennial sucker at this point. I should have stopped paying my mortgage 6 months ago. What was I thinking?
Yeah, it's a bit of a scary time. I think that reeling things in would be helpful.
Well, I just just a quick note on that, and again, it's things that I'm hearing every week that come up is trying to sell a property or trying to buy a property. You have to do underwriting, right? Or you're trying to lend on a property. How the heck are you underwriting any of this at this point, right? You almost have to either stick your head in the sand and say a year from now everything's going to be back to normal and we're going to be back to 2019 levels and just run your DCF that way, or you're just taking a total guess, right? So what are your assumptions on when this tenant rolls? What's the percentage that I get to lease up, and how long does it take to lease that space up? I think all of those assumptions, if they're not much, much more conservative now, then you're either, again, putting your head in the sand, or you're lying.
Well, Steve Witkoff said this week, he's made the decision to vote with his feet. He says, we have nothing in New York other than things that had been started years ago. We have no plans to be here. We find the environment inhospitable, and we're going to go to places like Miami, which we believe is a much more unified front between labor, business, the political side, and everything else. And he says, business will continue to flock in those directions where there is certainty, to your point. As an aside, I thought this was great too. He did mention that Miami Beach last weekend, 99% occupancy.
Yeah.
That's an incredible green shoot, and underscores my belief that we're going to see just explosive rebound in leisure hotel at some point.
In retail news, we saw a number of value reductions for malls and some other challenges.
Wow. This was the month where the wave of revaluations hit. It seemed like every day we were getting new remittance data and servicer data that just saw huge cuts in the valuation of malls. I'll run through a couple of them quickly. And there was like one or two every day. And we're not even done with the February remittance cycle. We still have some wood to cut. The Square One Mall in Saugus, Massachusetts, revalued 75% lower from its securitization level. The loan is now 35 million underwater. Dover Mall and Commons, Dover, Delaware, $80 million reduction in value, 35 million underwater. Crossroads Center in St. Cloud, Minnesota, it backs a CMBX 7 loan, 65% reduction in value, 25 million underwater. The other Crossroads Center, there's two of them. This one in Portage, Michigan, value down 85%, 55 million underwater. The borrower this month flagged that property is going to go deed in lieu in all likelihood. And the biggest one of all, Crystal Mall in Waterford, Connecticut, it backs a CMBX 6 loan, I believe. Value dropped from 153 million to 19 million, 88% reduction, $65 million underwater. So a couple of takeaways from this. Takeaway number one is that historically, investors have looked at losses and said, let me assume that this thing takes a 50% loss or a 55% loss or a 60% loss, right? That's the kind of thing. And it's going to take 12 months to recover, something like that. Here, what we're seeing is right off the bat on a valuation basis, things that are anywhere from 65 to 88% lower based on a third-party valuation. Point number two is that these valuations rarely, in the case of malls, stick. And when they get reappraised, it's usually lower the second time. We've seen this over and over again. We saw this 15 years ago. We saw this 10 years ago. We're seeing it now. There's no assurance that this Dover Mall, which was revalued $80 million lower, won't be revalued another $20 million lower in 6 months. So it is a real watershed month for the retail space.
So what's the effect on, I mean, bondholders have got to be looking at all this, right?
It's an interesting thing. This is what we call in the industry teeing me up. Joe's teeing me up. He's throwing me a softball. Yeah, so let's call this an educational segment. Bondholders have two types of credit protection when they buy a CMBS deal. One is at the loan level, right? A borrower has, let's say $100 million loan on a $150 million property. The borrower has $50 million in equity, right? There's an LTV of, 67% on that particular property. So the first loss theoretically shouldn't come to any bondholder, even the first loss bondholder, until that equity has been more than wiped out. Right.
33% plus drop in value.
Right.
Yeah.
So let's suppose that $150 million valuation falls to 75 million. So you're 25 million underwater, right? Now you're starting to say, let's look at the second level of protection we have. The second level of protection a bondholder has, if he's the AAA guy, is the fact that that next $25 million of loss will be endured by the first loss bondholder. And if his bond is wiped out, then the second loss bondholder, and further up the waterfall from the bottom up. So there's two types of credit enhancement that people have. So the metrics that bondholders use to assess their credit worthiness of their portfolio of loans is both the credit enhancement, how many bonds are behind my bond in percentage terms. Typically, they start out at AAA at 30% subordination levels. From there, you look at two other elements. You look at a defeased adjusted credit enhancement, which says, well, we know that these defeased loans will pay off. There's no chance that they will have a loan loss. What is my enhancement when I treat those as fully paid off? And so in that case, if all you had was defeased loans, your credit enhancement would go on your AAA maybe from 30% to 33%. On the other hand, your credit enhancement could get nicked. And on that level, people look at the appraisal reduction adjusted credit enhancement. And what that does is it says, for example, with the Crystal Mall, this is $65 million underwater. We are going to assume in our calculations that 65 million in losses write off bonds from the bottom up. Those losses wipe out the bond balances, and we recalculate our credit enhancement. And when that's taken into consideration, even though the bonds are still outstanding, the credit enhancement, it may not be 30%, it may be 21%. So I hope that made sense. It's a little bit of detail. If it didn't make sense, please feel free to reach out to us on Twitter or LinkedIn. We're happy to give you more details, but hopefully somebody learned something from that.
Well, and it's funny that I guess it's not something that people want to look at, but you can also do an LTV at the bond level, right? So like the loan to value, let's say it was a one loan deal, right? With multiple tranches. The bottom tranche in your scenario at the beginning would have a 67% LTV essentially, right? But the tranche above it would only have, a 55 or whatever it is, depending on how big it is. And by the time you get to the AAA level, the kind of bond LTV at that point is like what, 30% or 40% or something like that. So that's kind of another way of looking at it, where you need to eat through 60 or 70% of the value to get to the AAA level. And I think that's something when we've done kind of bespoke loan pricing in the past, that's kind of how we've looked at it, right? Where we'll take a loan and based on its value and its equity and its property type and some other things, and will essentially kind of jam it into a securitized structure and then come up with a weighted average coupon, weighted average yield to use as a discount rate, right? So again, that's probably getting too far in the weeds, but it's interesting that we don't show that, or that nobody really cares about that bond level LTV. And I've never really seen it anywhere else. So just spitballing here.
The Fed unveiled the 2021 stress testing scenarios. What are some of the key takeaways?
Well, it's funny because in the last several years, the scenarios will come out and the baseline will have moderate growth, unemployment rates staying relatively steady, and the severely adverse will wallop things like unemployment rate and GDP growth and commercial real estate prices. The problem this year is that some of those things have already been walloped, like GDP and unemployment. CRE prices, even as much as we talk about everything that's going on, in the headline numbers coming out of the Fed, you don't see much decline in the CRE price index. So the baseline is kind of a return to normal scenario. GDP growth is relatively strong, stronger than last year's scenarios, to try and get us back to normal average GDP growth of around 3% through the forecast scenario, which is 9 quarters. The unemployment rate kind of is higher than it used to be, but that's only because we're starting from a higher baseline. I think the more interesting one to look at always is the severely adverse. Historically, banks and other institutions that rely on these scenarios would often gasp when they saw the severely adverse scenario, and they would say, you know, how can we possibly be running this scenario? This is crazy. This is way too severe, and so on and so on. And then we kind of saw a 2-quarter severely adverse scenario actually take place in 2020. In the new one, the GDP growth, I would say, is less negative. So it's a little bit better than last year's severely adverse, about 30 basis points of negative growth on average through the first 9 quarters, and an increase of 1.9% thereafter. It's actually 13 quarters is the total length of the scenario. Unemployment rate peaks at 10.8%. I think last year it was slightly lower than that, and interest rates stay low. So that's the interesting thing about these scenarios, is there is some realism in them, in that they don't, if they really wanted to shock the heck out of bank balance sheets, they would apply this 40%, I think this year it's 40% CRE price drop, 55% stock market drop, and they would make the rates all wonky, right? But they actually keep the rates very low because they know that in a scenario like this, we would keep rates low.
The interesting thing about the time we've just been through is, I'm just kind of speculating here, the stress test is a blunt instrument, right? It takes a haircut to valuations across commercial real estate values, guillotine fashion, right? One big swoop across everything. What this black swan event has shown us is a couple of things. One is that different property types are going to behave differently. Number one, especially on the retail side. And number two is the length of the lease that you have and the tenant that you have locked in will change borrower behavior enormously. So your equity could go negative on an office loan on a mark-to-market basis, if you're slashing values by 45%. But if you have somebody locked in for 8 more years and you have 8 years to figure out their spatial needs and re-tenanting and everything else, that 45% haircut doesn't make nearly as much sense as the situation where the tenant has 18 months to go and you're coming out of a black swan. So it'll be interesting to see if, as with 2012, we saw a rethinking of default models across the board. Will the Fed and the major US banks use this as an opportunity to refine their models even more, to kind of reflect real risk with lease durations, credit quality of the tenant, and so forth becoming factored in?
Well, I think the interesting thing is that it's going to take years to kind of unravel what really the losses end up becoming, right? And what the true delinquencies and defaults are in the bank and balance sheet space. In CMBS, it's a lot cleaner, right? Because you can see there's an entity, there's a special servicer, there's a trust, and they have to act in a certain way, and they have to work through these loans, and they can't sell them off or put them in some other basket and not consider them delinquent. Whereas there's a lot more flexibility in the bank balance sheets. However, there's a few things, right? The stress testing regime that happened through Dodd-Frank and happened after the last financial crisis has caused banks to have to hold on to a lot more capital, right? So that has been a very good buffer for this black swan event. We haven't really seen any bank failures, I don't think, not yet anyway. And, banks have been able to modify and extend and not really run out of cash at this point. Now, when they're doing this stress test, here's the question. If I'm responding to the Federal Reserve with my stress testing results and I have a severely adverse scenario, wouldn't I say, you're never going to let me take loss, right? Like that's kind of I guess we're talking about what we were talking about when I was in school, moral hazard and all that type of stuff. But at this point, it's like, I've got capital galore. I've got TDR extensions and modifications where I don't have to hit my capital that hard, right? Like I've got forbearance agreements. I've got all this flexibility to where maybe I never need to collect my loan payments. Only suckers collect their loan payments.
I was going right there. You stole my line. Only suckers take losses.
Only suckers recognize delinquencies.
That's right.
Us CMBS folks are suckers.
And the deal of the week is not our typical deal of the week, but we felt it was an important one.
So the sonorous Casey Kasem, RIP, apparently they're listing his former house that has a heart-shaped pool in the backyard for $37.9 million in LA. I guess I didn't realize that he had died several years back, or I had forgotten that. It was very sad when you mentioned that to me in the pre-show.
2014.
I was a big fan of Casey Kasem. They play his old shows now on the 70s channel in your car. There's a lot of nostalgia in there. It was, a lot of my Saturday mornings when you're driving to swimming lessons, you'd have Casey Kasem on.
Was he Shaggy?
He was also Shaggy.
He was the voice of Shaggy, right?
He was the voice of Shaggy. So I was looking up just for historical records, what was, the number one song this week 35 years ago. And I won't, put you guys to the test. If we had a long form, I'd let you go through a couple of guesses, but it was Paul Simon's 50 Ways to Leave Your Lover. If I were to remake that song for the CMBS market, I would rewrite it as 50 ways to leave your mall keys. 50 ways to leave your mall keys with a special servicer.
Nice. I might have to redo the lyrics on that. And so on to the shout outs. Joe, you had one.
Yeah, so we have to give a shout out to David K at Friedman Realty. Great client of ours and always giving us great color on the market. Also Tommy Katz, who is the king of Trepp Loan. Love those guys. And Friedman, I know, has been working with special servicers for many, many years. And I think that they're one of the big, the big users of, this market.
And then we had a number of folks request webinar information, which we talked about quite a bit today. Tyler A., Laura L., Stephen M., and Matthew O., who said he's also a big fan of the podcast. We had Joel R. comment on our CECL blog. He thought it was a good explanation about how the banks are dealing with CECL. Yanni M. liked Joe's story about New York City rent last week and had a similar story that he shared with us. Tammy Goldfisher, who's been a guest, actually shared one of our posts on her LinkedIn account. John B. gave a shout out to us, and we always say we like to hear what you're doing while you're listening to the podcast. Apparently, he listens while he took his daughter to swimming lessons. So that was interesting. He also gave us some feedback, and I think Manus has another lunch invitation. So Joe and I are getting a little jealous, I think. Yam R noted that his clients are always raving about the podcast. So thank you for those.
So Yanni gave us a good story of, we talked about our friend who had moved out of her apartment last week and looked back at Zillow and saw that they were listing her apartment for like $1,500 per month less than what she was paying. And then she realized that she should have negotiated. I think most people who are listening to this podcast probably negotiate for a living, but I think it's probably taken for granted by a lot of people that you can always say no and you can always push back on a landlord or on anybody else. But anyway, Yanni was mentioning that he's seeing stories and, seeing friends in buildings where they're putting up phantom listings, right? So they'll put up a listing of an apartment for $3,000 a month that they're not actually renting for $3,000 a month, right? Just to keep the headline numbers higher and to convince their current tenants that that's the market rent. So very interesting. I said there's probably a business there for someone who wants to. It's like the Russian Instagram followers. I can go buy like 50,000 Instagram followers if I want. Maybe I could, sell some fake Zillow listings to the landlords in New York.
And with the winter storm shutting down Texas this week, millions were without power and heat. And one Houston retail owner opened up his furniture store to shelter those left in the cold. So James Mackingdale, known as Mattress Mac, had hundreds of people spend a night on couches and mattresses. He's got a generator for electricity, water for the bathrooms, and apparently people are extremely grateful.
I had a situation once in a Stearns where the guy in the mattress department sheltered me from the wedding registry gift walk. My wife and I were going through Stearns or Macy's or Bloomingdale's, whatever it was, and I had done it for 45 minutes and I was ready to tap out. And I went to the bedding department and I snuggled up. I didn't really snuggle up. I went, 2 hands behind the head, fully stretched out on that king size bed. And he let me stay there for a good 20 minutes. Did the trick.
And with that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we discuss what's happened during the week and how it may be impacting you. If you have a question or a comment, send us an email at podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.